Alright, let's dive into this super cool trading tool called the Lowest Channel Plus RSI by ChartPry. It's a slick indicator that uses a unique smoothing method called LOS to make trends pop out clearly. Thus, it comes with these handy channel lines and an RSI gauge to help you catch potential reversals or gauge momentum. We're going to break down what this thing does and how you can use it in your trading. If you're digging this, give that like button a tap. To get this bad boy on your chart, head over to TradingView, the platform I'm working here. No account? No sweat. There's a link in the description to sign up. Once you're in, pick your favorite market and time frame. Then hit the indicators button at the top and search for lowest channel. You want the one labeled the lowest channel plus RSI by ChartPry. Click it and boom, it's on your chart. Folks, meet the awesome lowest channel plus RSI indicator. It uses this smart math trick to smooth out price swings, cutting through market noise with barely any lag. This gives you a crystal clear view of the trend and spots potential turning points with dynamic channels and RSI reading. So what's on the chart? First, you've got this bold center line. That's the lowest line itself. It switches colors, maybe purple to green, showing you the trend's vibe. Green for bullish, purple for bearish. It's great at dodging false signals. When the color flips, you spot these little diamond markers on your chart, flagging a possible trend shift or reversal. Wrapping around that main line are dashed lines forming a channel. These are volatility-based bands, tied to something like ATR, and they widen or shrink depending on price action. Think of them as zones where the price might be stretched too far. When the price hits or nears these outer bands, it could hit at a bounce back toward the center. Perfect for spotting reversals or even scalping, since prices often snap back hard from these levels. Oh, and check this out. On the right side of your chart, by the latest candles, there's this vertical gauge. That's the RSI gauge, showing the relative strength index right in the price channel's context. It's a quick way to see if the market's overbought or oversold. Now, let's pop into the settings for a sec. You can tweak this thing a ton, adjust the length for the lowest calculations. Smaller numbers make the lines and bands react faster, great for scalpers or shorter-term traders. Bump it up and you get a smoother vibe, filtering noise for longer-term trends. You can also mess with the band width, change colors, or toggle the RSI gauge on or off, even tweaking its length. So play around to find what fits your style. Next, let's chat about using this indicator to trade. One easy way is to follow the main lowest line's color. Green, look for buys. Purple, think sells. Those diamonds, when the color changes, can confirm a trend shift. Another approach is using the outer bands. If the price drops and tags the lower band, it might be oversold, suggesting a bounce or reversal up. If it hits the upper band, it could overbought, hinting at a drop. The RSI gauge backs this up. For a bullish trade, wait for the price to near the lower band. Then check the RSI. If it's low, showing oversold, that combo boosts your confidence for a bounce. Look for a bullish candle pattern to enter. For bearish trades, it's the opposite. Price at the upper band with the high RSI reading signals overbought, so wait for a sell signal to short. Pairing the band touch with RSI helps you pick better trades. To sum it up, the lowest channel plus RSI is a killer tool, blending advanced smoothing for a short-term line, dynamic volatility bands, and a built-in RSI gauge. It lets you track trends, spot overbought or oversold zones, and check momentum all in one. It's versatile for trend following or catching reversals. I've got a killer 3-step trading formula that I've practiced thousands of times, and it's been profitable every single month in the long run. No fancy indicators, no chart patterns, just raw price action. By the end of this video, you'll know this strategy inside out and be ready to take calculated trades that can stack serious cash. Let's dive in. Step 1 is all about market structure, and it's make or break. Mess this up even a little and the whole strategy falls apart. Every trader learns uptrends and downtrends early on. It's like the baby bottle of trading. Higher highs and higher lows, uptrend. Lower lows and lower highs, of course, downtrend. Basic stuff, right? But what if I told you you're probably doing it wrong? Here's the deal. Say a chart's making higher highs and lows, clear uptrend. Then price dips, break a low, and tons of traders think reversal, downtrend. They start shorting, expecting a drop, but surprise, this chart's still bullish. That low? It's not legit unless it breaks the previous high. A valid low only forms after price smashes through the prior high. If it doesn't, that low is just noise. So if the price breaks a high, that's it's a valid low. Now you're in an uptrend, and you only hunt long trades. Short trades? Only if price cracks that valid low. Price can wiggle up, down, sideways, whatever. As long as it doesn't break that low, you're still bullish. If price dips and breaks a low without clearing the prior high, it's not valid. So you stay in an uptrend mode. If price breaks a high instead, the valid low shifts to the new one. Key rule, a low is only valid if it breaks the previous high. Nail that and you'll always know if you're in a bullish or bearish trend. Step 2. Spotting supply and demand zones. Demand zones form in uptrends, supply zones in downtrends. Buy from demand, sell from supply. Why? In an uptrend, a big upward push from a zone shows buyers were hyped there. If price revisits, traders will likely buy again. Supply zones are the opposite. A sharp drop signals sellers jumping in, so a retest could spark another sell-off. This is the heart of the strategy. Let's test it on a real chart. Price moves up, dips, then breaks a previous high. Higher highs, higher lows, so uptrend. Only look for longs, no short. This low, having broken the prior high, is valid, and price stays bullish unless it breaks here. Buy in the demand zone where price consolidated or went sideways before a sharp upward move. Mark the candle just before that move from its low to high using a rectangle tool. That's your demand zone. Wait for price to re-enter. Set a stop below the zone, take profit at the recent highs, and boom, winning trade. Another example, price makes higher highs and lows. Uptrend, the low that broke the prior high is valid, so only long trades. Price breaks that low, shifting to a downtrend. Now mark supply zones where price consolidated before a sharp drop. Price retests the supply zone, enter short, stop above the zone, take profit at recent lows. Easy win. Another supply zone forms, still in a downtrend. Retest, enter short, same stop and target. And guess what? Another winner. This repeats racking up trades in the trend's direction, boosting your win rates big time. Step 3. Risk to reward. Even if a trade checks all boxes, skip it if a risk reward is under 2.5 to 1. For every $100 risk, you want $250 back. This rule skyrockets profitability. Find an example. Price makes higher highs and lows. Uptrend, so mark demand zones. Price consolidates, then shoots up. Mark the demand zone, wait for a retest, enter long, stop below the zone, take profit at recent highs. Check risk to reward ratio. It's 3 to 1, so green light. If it's below 2.5, pass. Price plays out, and you bag a clean win. Rinse and repeat. This is strategy beast, hyper accurate and trend aligned for max wins. Test it yourself with price action and backtesting before trading real money. This isn't financial advice though. Love this? Smash that like button and subscribe. Catch you next time.